Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris rapeseed, Winnipeg canola, and Malaysian palm oil.
Paris rapeseed. 19 weeks ago, I detailed some key bearish pressures that the market had back then started dealing with. The reason I repeat them now is because the levels have once again become significant. They were, and I quote, "We have overhead a more diaphanous congestion band between 456 3/4 to 468 3/4, a band that was relatively easier to navigate than the others mentioned," end of quote. Moving now back to more recent times, in early March, the market punched up from below, through and over, both the short-medium moving average, currently at 431 1/4, and the medium moving average, currently at 434 even. Up through the key overhead congestions mentioned in my earlier commentaries, between 438 even to 45 3/4. Through the gold highlighted flatlining long moving average, currently 447 even, and peaking and closing yesterday for a second and third time in the last 2 weeks over the significant 50% Fibonacci line of the May to July 2023 move of 456.5. Now I also added the following comments 5 weeks ago, and I quote, "We have seen a turn towards the bullish with a move up and test of not only the upper time but the green short medium moving average that is supposedly reinforcing it. This is not a major turn, not yet, but it's not far away from being one. If we do turn higher properly, and the first key level is not far away at the February high at 427 even, we could see significant recovery higher," for end of quote. Now I further added, and I quote, "The reason I say 427 is that any move over that level would set up the opportunity for a possible double bottom over mid-January to date, the mid-January to date period. So watch what happens up at the green short medium moving average, the 427 even level, and the medium moving average," end of quote. Well, we have formed a double bottom, and I laid out 4 weeks ago some potentials for the move higher, and I quote, "A secondary harder to reach target for the recent double bottom pattern would be in the 446.5 area. The primary target has already been achieved. The secondary harder to achieve target X1 is in the 446 3/4 area," end of quote. Both these targets, target X and X1, have been achieved, and I will retire them after this commentary. 2 weeks ago, I asked the following, and I quote, "The question now is what's next? Well, these pattern targets and resistances sit within the larger, more recent November to mid-December 2023 congestion band that stretches from the June 2013 high at 438 even up to the 50% Fibonacci of the May to July 2023 move up at 456.5. I said about this congestion band 2 weeks ago, so that is now 4 weeks ago. So I said about this congestion band 2 weeks ago, and I quote, "The action lower this year has potentially more ammunition, enough to take on a substantial but smaller overhead resistance area should it choose to," end of quote. 2 weeks ago, I was awaiting indications on what may happen next, and this week it has become somewhat clearer. We have a mid-March to date rising wedge pattern, currently 449 even to 462 even, highlighted in dark blue on my daily chart. It is a small to medium-sized pattern, and we are well within it at this time, with plenty of touches actually on either side. What I am looking for now is the establishment of the market over the 50% Fibonacci line at 456.5, and rejection of any testing of the gold-colored long-moving average below. In the meantime, it's worth looking at the data for such a pattern, and it is interesting. For starters, though it is allowed for markets to move up into such a pattern, it is usually seen in a move lower. That being said, something like 8 out of 10 times the breakout overall from rising wedge patterns is on the downside. So please bear that in mind. Winnipeg canola. The market here was slowed and eventually halted in its decline since July last year by the approach in February to the December 2020 low at 567 even. The halt ended up as a nice neat horn bottom that rallied prices higher during late February and into March, up through the May 2023 low at 611.10, the 2021 low at 629.60, the descending short medium moving average currently at 617.20, and most recently the mauve highlighted medium moving average currently 637.70, and the June 2021 low at 655.90. These last two, especially the mauve medium moving average, eroded the bullish incentive enough that the market halted and has rebuffed testing of the next overhead resistance, the dark blue highlighted neckline currently at 658.20 of the April to June 2023 reverse head and shoulders continuation pattern. I said as much 4 weeks ago, and I quote, "It's timely to look at further overhead resistances, and the next ones are the June 2021 low at 655.90 and the neckline of the April to June reverse head and shoulders continuation pattern." End of quote. However, to be completely honest, I tempered this at the time with the following, and I quote, "I am unsure about how effective these will be." End of quote. Now, I should not have been worried, as between these two the market was capped and prices have dipped lower, but only so far as to the 2021 low. However, the opportunity now exists for the action since November last year to date to be a possible descending scallop pattern in construction. I'm not sure on this idea, but it would like to put it out there in case we see further declines. Finally, I would only once again add the following as a postscript to what I have already said. It's something I said first time around 15 weeks ago, and I quote, "I would add this final thought. I'm increasingly becoming interested in knowing if this contract is really an indicator, a leader, if you will, of what the other oilseeds and veg oils may have to deal with." End of quote. To this I added 4 weeks ago, and I quote, "This also means on any recovery and move back up, and not only on the way down." End of quote. Bursa Malaysia crude palm oil. If you have listened to any of my commentaries here on palm oil, you would have heard me repeat so many times that the mid-August to early November 2022 had been running bearish shift pitchfork, had been running the show here. In January this year, the market rose up to test the upper time, and then again in February and in early March. In mid-January and mid-February, we saw the upper time currently at 39.05 breached, but then only with a single close over on each occasion. Not so 6 weeks ago, when we had multiple closes over the upper time, followed by exploitation of the breach higher, turning into a proper break higher, and the end of this venerable bearish shift pitchfork. Now, I was going to retire it after my last commentary, but it so defines this market that I've chosen for now to keep it on my daily chart, if in an unhighlighted, demoted, semi-retired position. So, going back a few steps first, one of the significant patterns at one time or another, one that's important right now, highlighted in bright red on my daily chart, is the neckline, currently at 42.30 of the September 2015 to November 2017 head and shoulders top. At one time or other, this had acted as a support and a resistance, and most recently, a support that helped drive prices higher, rising enough that 2 weeks ago I considered it may have made a strategic change in the overall longer-term bearish perception of this market. During the middle to end of March, when the market had punched up over the bright red neckline and then stabilized over it, I gave my thoughts 4 weeks ago on what was going on, and I quote, "So what now?" Well, for this, I went to my standby on such occasions, the longer-term monthly charts, and there was one clear standout level that needed to be watched, and that was the November 2022 high at 44.08. This is a key level on the top side, because if it is broken, and I mean properly broken, then there are very significant potentials topside. Similarly, if it holds, then there are very significant potentials on the downside. So watch to see if the prices reach up the 4408 area, and then what prices do at that level. Last week prices punched down through and closed over 4408, moving higher, but this was limited, as the December 2021 low at 4467, the August 2022 high at 4484, and the approach to the June 2022 low at 4559, all these eroded the bullish incentive. But there was one specific level that stopped, at least temporarily, turned prices lower late last week, and actually this week, and that was the erosion by the earlier March 2008 all-time high back then at 4484. This has prompted me to ask whether the run-up since late February is really a bullish hesitation, even a bull flag if you like, or is still, after all, a topping action. To be honest, the jury is still out on this one, as we stay between the bright red neckline below and the March 2008 previous all-time high that's above.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.